Whether it's small caps or large caps, our next guest helps institutional investors chart the right course in the options market. And while he remains fairly bullish about equities in the long term, he says be careful about January. There could be a surprising correction here. Joining me now is Richard Anthony. He heads derivatives and equities for BGC Partners. And Richard helped design the option scenario analysis, or the OSA function on the Bloomberg terminal. So you know your way around this machine and the market. A pleasure to have you on the show. Let's talk, first of all, about the gains we're seeing today. More than 1% across the board, and I'm reading increasingly about the fact that everyone out there is bullish. Investors, analysts, even economists are turning bullish. Is it a dangerous situation?
Well, you're spot on, Matt. Every single phone call I had today with our clients was bullish in one respect or another. People were hesitant to put new hedges on. People were hesitant to add to hedges if they already had them on. Everyone is feeling very joyous after the new year.
Do you think that people forget the lessons of just, 3-4 years ago? I mean, chasing that extra couple of points in yield. You say they're hesitant to put hedges on. Don't you think that we want to remain conservative after the collapse that we've witnessed in 2008?
Well, that's my thinking. I mean, we're up, close to 90% from the 09 low. It's been quite a run in a short period of time. We've had volatility plummet across every single indice globally, and it's a time where I would think one would have to be a little cautious. We've had a good run here.
Why do we see the VIX come down so low? It's been called the fear gauge. A lot of people look at it as a measure of volatility out there. It's only at 17.4. I mean, I remember when that was a high number, but still it was up in the 80s and 90s after Lehman Brothers.
Well, that's a good point. That's where our give and take is happening. I remember trading it, buying it at 10 and selling it at 20 for 3 years. So it just depends. It's relative. 17 could be 10. 17 could be on its way back to 47 like we saw last year during the flash crash.
All right, guys, I'm going to kick out the first question because Richard and I were talking about the Russell 2000 index hitting a high. We're talking about the VIX and how low it is, but the RVX index measures volatility on the Russell is up 25%. Does that mean we're near a top? I mean, does that portend a drop is coming?
Well, it's an interesting divergence, isn't it? I mean, the Russell was up 2.5% when I left my office, and Russell Vol's up 25% from where it just was. Why?
And yeah, right. Usually when markets go up, the vol comes down because everyone's getting quiet and complacent. And you're saying it's the opposite.
Exactly. And this is the index that's been the most powerful, 2x the return of the S&P. But do we have a warning sign?
Well, that's the interesting part, right? I mean, when you're talking about market technicians, you're talking about people who look at charts, right? They look for patterns, convergences, divergences. And this is an interesting divergence here in what's happening. Possibly an issue for a lot of people to say, hey, maybe it's time to put on some maybe put protection.
Well, exactly. I mean, if I was running a large book and I saw this divergence, I would be taking notice.
By the same token, here's the thing. If the Russell volatility is getting higher, in other words, that means that the input pricing, the vol, as options traders like to say, is getting more expensive, so the options are getting more expensive. So it's actually costing you a lot more to put the hedge on.
It's costing you a little bit more to put it on, absolutely. But you could offset that cost by using a spread, for example, which would take
give us
advantage.
An example.
Well, you could buy an at-the-money put and sell an out-of-the-money put and pick up a little bit of what they call the volatility skew, because the lower the strike of the put, the higher the implied vol.
Options traders love these conversations. If you don't trade options right now, you have no idea what he just said.
If we were on surveillance midday, Tom Keene would have hit the jargon alert button about 20 times.
Jargon alert.
All right, I'm guilty as charged.
Now, Richard, though, the interesting part here, though, that's not the case. You just put up a chart there, the Russell Vol. It's actually still pretty low, just like the VIX is fairly low, just like a lot of options prices are fairly low right now. We've been talking to a lot of people in the street out there, basically saying that buying insurance right now is cheap. So should people be out there looking to kind of
Well, and you say they're not buying enough and they're not hedging as much as they maybe were.
And it is cheap. I was just making a note on this particular index being
Russell.
off its low, the vol index being off its low. But yes, to your points, vol is low, relatively speaking. Index protection is cheap, and if you're going to do it, I would do it with the naked put options. I wouldn't do the spreads.
In other words, you just buy puts.
I would.
Even if you're paying a little more.
And that's most of your business, right? That's most of your business, isn't it? I mean, when over at BGC, you're not doing these crazy, complicated trades for most of your clients. You're just selling and buying single equity options.
Well, we give advice. We help our clients structure. We help our clients manage the Greeks. The way we look at optionality is not premium strike price, and expiry, we look at, jargon alert, delta gamma, theta, vega. So we help demystify the four moving parts in this nonlinear
Well, actually, we were speaking, Dom and I were talking when we were discussing you coming on today, a Greek today, the alpha. On the one hand, you got to worry about hedging against losses, right? On the other hand, what do you recommend to clients who want to outperform the market? How do you use options to create more alpha?
75 to 80% of our business is single stock equity options. That's where most of the mispricings are. That's where you can really stick your toothpick into the option lumberyard.
And that's a metaphor I haven't heard. So are we talking about going deep in the money? Are we talking going far out on the term structure, 2 years out there? I mean, where do you find the inefficiencies?
Well, in the single stocks, it's typically 1 to 4 months out in time. The higher vol, the shorter dated you would be. The lower vol, the longer dated you have to be.
Let me ask you about what you see from looking at the options market all day for. You've been in the business for at least 2 or 3 years now, right?
Mm-hmm.
What is the options market telling us for 2011? I mean, besides the volatility, besides the RVX, what are you seeing in general?
Well, here's the thing. The last 2 years, the easy money's been made, right? So this year
just by being long.
Just by being long. So this year should really be where the skill wins out. Now, in my opinion, if you add optimal use of optionality in the names where options can be used to enhance your return versus the linear alternative, this is the year where you're going to need to do that.
And you do that by selling calls against stocks you're long or buying cheap puts?
In a rising market, I mean, selling calls against long positions that you have could be a great way to kind of increase yield, right?
Not bad, but if you sell a put and buy a call spread, your return will be higher and your risk will be the same.
Now, let me just quickly ask you, because obviously you want people to buy more options. That's your business. Are you concerned about regulation?
Well, regulation is going to be good for us because we trade exchange. We are backed by the OCC. We're not the OTC desk. So the more that comes on exchange, the more regulation, the better it is for our business.
So if I heard you right, you're saying don't buy the stock. Talk to an options guy, figure out an options trade, you put less money up, and you still have cash? Is that what I'm hearing you say?
Yes and no. I wouldn't get stuck on the less money up part, but there is always going to be an alternative between linear, bet one to make one, and nonlinear, where it'll be something different than that.
And that's the options market.
Yeah, and I'm not saying it's better or worse. I'm saying it's different.
All right. Hey, Richard, it's a pleasure having you on. We've got to get you back in here. Richard Anthony from BGC Partners.
A lot more to discuss, guys.
There's a lot more to discuss. Thanks very much. We're going to take